Johan here from Johan Videos. If this is your first time watching this channel, let me make something very clear right now. I don't do clickbait. I don't hype prices to farm views. And I absolutely do not sugarcoat reality to make you feel comfortable about your positions. This channel exists for one reason only: to cut through the noise, the manipulation, and the propaganda that mainstream financial media feeds you every single day. If you want someone to tell you everything's going to be fine, go watch CNBC. If you want the truth backed by data, you're in the right place. Now, before we get into what just happened in the silver market over the last 72 hours, and trust me, what I'm about to show you is going to shake your understanding of how these markets actually work. I need you to do something. Drop a comment right now. Write flash crash if you got stopped out during this move. Write buying if you used the dip to add physical. Write confused if you have no idea what's actually happening. Or just write Johan if you're here for the raw analysis. I want to see where this community stands, because what I'm about to break down affects every single person holding silver, trading silver futures, or invested in mining stocks. Let's go. Here's what happened. Silver was trading at $120 per ounce just 48 hours ago. 120, that's not some speculative number. That's the actual COMEX settlement price that was printed on every trading terminal across the world. Then, in the span of less than 36 hours, silver flash crashed to $95 per ounce. 95. A $25 drop. That's a 20.8% collapse in a commodity market in a day and a half. Let me repeat that because the magnitude needs to sink in. Silver, a global commodity with trillions of dollars in industrial applications, solar panels, electric vehicles, electronics, military hardware, lost over 20% of its value in less than 2 trading sessions. If you've been in these markets for any length of time, you know that kind of move doesn't just happen organically. That's not regular market volatility. That's not profit taking after a rally. That's coordinated, institutional scale selling, designed to trigger stop losses, margin calls, and forced liquidations. That's a takedown. And if you think I'm being dramatic, let me ask you this. When was the last time you saw a commodity with as much industrial demand as silver dropped 20% in 36 hours during a period when global supply is constrained, industrial consumption is at all-time highs, and central banks around the world are diversifying away from the US dollar? I'll wait. Because the fundamentals that should support silver prices haven't changed. Chinese solar panel production hasn't stopped. Electric vehicle manufacturers haven't canceled their orders. The US reshoring of critical supply chains hasn't been reversed. Yet somehow, silver just lost a fifth of its value faster than most stocks crashed during a market panic. That alone should tell you this wasn't a natural move. This was engineered. But here's where the story gets absolutely insane. While COMEX silver was crashing from 120 to 95, while paper contract holders were getting obliterated, while leveraged longs were getting margin called out of their positions, physical silver in Shanghai was trading at $136 per ounce. 136. Not 100, not 110, 136. That means while New York was printing 95, Shanghai was paying $41 more. $41 per ounce premium. Let that sink in for a second. A $41 premium. That's not a spread. That's not a regional price difference. That's a completely different reality. That's 2 separate markets operating in 2 entirely different universes. One where paper contracts get manipulated by bullion banks with unlimited selling power, and another where physical buyers who actually need the metal are bidding based on real supply and demand. And the physical market is saying silver is worth 136, while the paper market is saying it is worth 95. If that doesn't tell you everything you need to know about the legitimacy of COMEX pricing, I don't know what will. Now, you might be asking, Johan, how is this even possible? How can the same commodity trade at 2 completely different prices in 2 of the world's largest markets at the same time? Shouldn't arbitrage close that gap immediately? Under normal circumstances, yes, arbitrage should flood in. Traders should buy COMEX at 95, ship the metal to Shanghai, sell at 136, and pocket a $41 profit per ounce. That's free money. That's the textbook mechanism that's supposed to keep global commodity prices aligned. But here's the problem. You can't arbitrage what doesn't exist. You can't buy physical silver on COMEX and ship it to Shanghai if there's no physical silver available to withdraw from COMEX vaults. And based on the depository data I've been tracking, and we'll get into the specifics in a minute, COMEX registered silver inventory has been absolutely hemorrhaging for weeks. We're talking tens of millions of ounces leaving the warehouses. So when Shanghai is bidding 136 and COMEX is printing 95, the arbitrage can't happen, because the physical metal that would normally flow from the cheaper market to the expensive market is not available. The COMEX vaults are being drained, the bullion banks don't have the metal to deliver, and the paper contracts that just crashed to 95 are backed by a fractional reserve system that's on the verge of breaking. That $41 premium isn't a pricing anomaly, it's a stress signal. It's the physical market screaming that there's a supply crisis, while the paper market pretends everything is fine. So what triggered this flash crash? What caused a $25 drop in 36 hours? Well, here's where things get even more interesting. Just 2 days before the crash, President Trump announced his pick for Federal Reserve Vice Chair. And this isn't just any appointment. This is someone who's been openly critical of precious metals, someone who's on record saying that gold and silver have no place in modern monetary systems, and someone who's closely aligned with the big money center banks that have massive short positions in the silver market. Now, I'm not going to sit here and claim I have proof that this appointment directly caused the crash. I don't have access to the trading algorithms or the phone calls that happened behind closed doors, but I will tell you this. The timing is suspicious as hell. Trump announces a Fed pick who's hostile to precious metals. Within 48 hours, silver crashes 20% on massive selling volume that hits the market during low liquidity hours. And the mainstream financial media, which should be all over a story about a major commodity crashing this hard, this fast, is completely silent. Not a single headline, not a single investigation into who was doing the selling or why. Just radio silence? You don't find that strange? Because I sure as hell do. Let me walk you through what the data is actually showing, because this is where you separate facts from speculation. According to the latest COMEX depository reports, and these are publicly available documents that anyone can verify on the CME website, registered silver inventory. The portion of warehouse stocks that's available for delivery against futures contracts dropped by 18.4 million ounces over the last 2 weeks. 18.4 million. That's not a small withdrawal. That's institutional scale removal of physical metal from the system. Let me break down some of the specific movements because the details matter. JP Morgan, the bank that holds the largest short position in silver according to the latest CFTC Commitment of Traders data, saw net outflows from its registered vaults of over 4 million ounces. 4 million ounces leaving JP Morgan warehouses in 2 weeks. HSBC, another major bullion bank, withdrew 2.8 million ounces. Brinks, one of the largest precious metal storage facilities in North America, had outflows of 3.2 million ounces. Delaware Depository saw withdrawals of 1.9 million ounces. And when you add up all the movements across all the major vaults, the total registered inventory available for delivery dropped from 132 million ounces to 113.6 million ounces. That's a 14% decline in available physical silver in just 14 days. 14%. And this is happening while open interest, the total number of outstanding futures contracts, is sitting at over 260,000 contracts. Each contract represents 5,000 ounces. Do the math. That's 1.3 billion ounces of paper claims against 113.6 million ounces of registered physical. That's a ratio of 11.4 to 1. 11 paper claims for every 1 ounce of deliverable metal. And that ratio is getting worse every single day because inventory keeps dropping, but open interest stays elevated. Now, here's where it gets really uncomfortable for the bullion banks. During the flash crash from 120 to 95, you would expect to see massive liquidation of long positions in the futures market. You would expect open interest to drop significantly as leveraged traders got stopped out or margin called, but that's not what happened. Open interest only dropped by about 12,000 contracts. 12,000 out of 260,000. That's less than 5%, which means the vast majority of long positions stayed in place despite a 20% price crash. So if the longs didn't liquidate, who was doing all the selling that drove the price from 120 to 95? Well, according to the volume data, the majority of the selling volume hit the market between 2 a.m. and 5 a.m. Eastern Time. That's the lowest liquidity period in the trading day when most U.S. traders are asleep, Asian markets are winding down, and European markets haven't opened yet. It's the exact time window when you can move markets with the least amount of capital because there are fewer buyers to absorb the selling pressure. And the sell orders came in waves. Huge blocks of contracts dumped within minutes of each other, triggering algorithmic stop losses and cascading liquidations. That's not organic selling. That's not retail traders deciding to exit their positions at 3 a.m. That's institutional manipulation. That's someone with deep pockets and access to market-making privileges flooding the order book with sell orders specifically timed to maximize downward price impact. And based on the CFTC data showing which banks hold the largest short positions, it's not hard to figure out who benefits from a move like this. But here's the part that should genuinely terrify anyone who's short silver futures. Despite the flash crash, despite the $25 drop, despite every mainstream outlet that bothered to cover the story, calling it a silver collapse, physical demand hasn't weakened. Not even a little bit. In fact, it's intensified. Dealers across the United States are reporting that physical silver premiums over spot price have widened since the crash. Before the drop, you could buy a 1-ounce American Silver Eagle for about $5 over spot. Now dealers are charging $8 to $12 over spot. In some cases, premiums have doubled. Why? Because retail buyers looked at silver crashing from 120 to 95 and said, "That's a gift I'm buying." So physical demand surged. Meanwhile, dealer inventories are getting hammered because the wholesalers they buy from are struggling to source metal. And when you call the big distributors to ask why supply is tight, they'll tell you the same thing. The mints can't get enough blank silver to strike coins. The refineries are running at capacity but can't keep up with orders. And the primary suppliers, the ones who actually move physical metal in bulk, are reporting that premiums from their sources have gone up, not down, since the COMEX crash. So you have a situation where the paper price crashed 20%, but the physical market is tighter than it was before the crash. That's not how supply and demand is supposed to work. If the price of something drops, demand should decrease and supply should become more available. But the opposite is happening. Physical is getting harder to source and buyers are paying higher premiums. That's a broken market. That's a market where the pricing mechanism has completely detached from reality. Now let's talk about China, because this is where the entire narrative falls apart for anyone trying to claim the crash was justified by fundamentals. Shanghai physical silver, as I mentioned earlier, is trading at $136 per ounce right now. That's $41 above the COMEX paper price. And that premium has been stable for the last 48 hours. It didn't compress when COMEX crashed. It didn't follow New York lower. It stayed at 136. Chinese industrial buyers, the people who actually use silver to manufacture solar panels and electronics and electric vehicle components, looked at the COMEX crash and said, "We don't care what your paper market is doing. We need physical metal, and we're willing to pay 136 to get it." That tells you everything you need to know about which market is real and which market is a fiction. The Chinese aren't buying silver to speculate on price moves. They're buying it because their production lines require it. Solar panel manufacturers can't stop their factories because COMEX says silver should be 95. They need the metal regardless of price. And if the global physical market is tight, they'll pay whatever premium is necessary to secure supply. That's real demand. That's the actual market. And it's saying silver is worth 136, not 95. But it's not just China. Reports from India, another massive consumer of silver, show similar dynamics. Indian silver imports hit record levels in recent months as jewelry fabricators and industrial users front-run potential supply shortages. The Indian domestic silver price is also trading at a significant premium to COMEX. We're talking $15 to $20 per ounce over spot in some regions. And like China, Indian buyers didn't reduce their purchasing during the flash crash. If anything, they accelerated because they recognized the paper price drop as artificial and temporary. So you have the two largest silver-consuming nations on the planet, both paying significant premiums over COMEX, and both refusing to follow the paper market lower. Meanwhile, the Western financial media is publishing articles about how silver collapsed and the bull market is over. Do you see the disconnect? The actual consumers of silver, the people who use it for industrial production, are telling you through their buying behavior that the metal is scarce and valuable. But the paper traders and the financial press are telling you it's collapsing. One of these groups is lying to you. And I'll give you a hint. It's not the Chinese solar manufacturers paying $41 over spot. Let me give you some context on Trump's Fed pick because this is important. The person Trump nominated for Federal Reserve Vice Chair has a long history in the financial sector. This individual previously worked for Goldman Sachs, served on the board of several major financial institutions, and has publicly stated that precious metals are relics of the past with no role in modern economies. In a 2019 interview, this person said, and I'm paraphrasing here, that gold and silver bugs are conspiracy theorists who don't understand monetary policy. That's the person who's about to have significant influence over U.S. interest rate policy and regulatory oversight of the banking system. Now, why does that matter for silver? Because the big money center banks, JP Morgan, HSBC, Citigroup, Bank of America, hold enormous short positions in the silver futures market. According to the most recent CFTC Commitment of Traders report, commercial banks are short over 400 million ounces of silver through futures and options contracts. 400 million ounces. And if silver prices rise significantly, those banks face potential losses in the billions of dollars. So having someone at the Fed who's ideologically opposed to precious metals and aligned with the banking establishment creates a very convenient situation for those banks. It gives them political cover to continue manipulating the silver market without fear of regulatory scrutiny. And it raises the very real possibility that the flash crash we just saw was coordinated with the knowledge that the incoming Fed leadership won't investigate or penalize the parties responsible. Now, I want to be very clear about something. I'm not saying Trump personally ordered a silver market crash. I'm not claiming there's a smoking gun memo where the president told JP Morgan to dump futures contracts. I don't have that kind of evidence, and I'm not going to make claims I can't back up. What I am saying is that the timing is extraordinarily suspicious. The Trump administration announces a Fed pick who's hostile to precious metals. Within 48 hours, silver experiences one of the most violent flash crashes in recent history. The selling happens during the lowest liquidity hours, with characteristics that match previous documented cases of market manipulation. And the mainstream media, which should be investigating such an unusual market move, is completely silent. Those are facts. The interpretation is up to you. But if you think it's all just a coincidence, I've got a bridge to sell you. Let's talk about the technical picture, because this matters for anyone trying to understand where silver goes from here. Before the crash, silver had built a very strong technical base above $100. The 20-day moving average was at 108. The 50-day was at 102. The 200-day was at 94. So when silver crashed to 95, it briefly touched the 200-day moving average and then immediately bounced. We're currently trading around 103 as I'm recording this, which means silver recovered $8 from the low in less than 24 hours. That's not the price action of a market that's genuinely collapsing. That's the price action of a market that got pushed down artificially, hit strong support, and snapped back because the underlying demand is real. If silver was truly in a bearish collapse, you would expect the price to break through support levels and keep falling with weak bounce attempts. But instead, we got a V-shaped recovery off the lows. That's classic manipulation fingerprint. Smash the price down fast, trigger stops, shake out weak hands, and then let it recover because the fundamentals haven't changed. Institutions who know what they're doing use crashes like this to accumulate at lower prices. Retail traders who panic sell at the bottom are the ones who get hurt. Now, here's what I'm watching over the next several days and weeks, because this is how you navigate a manipulated market. First, does the Shanghai premium compress or stay elevated? If Chinese physical buyers continue paying 130 plus regardless of COMEX price action, that tells you the physical shortage is real and persistent. Second, do COMEX registered withdrawals continue? If we see another 10 to 15 million ounces leave the warehouses over the next 2 weeks, the available inventory situation becomes critical. At some point, there won't be enough registered metal left to deliver against the outstanding contracts. Third, watch the lease rates. Silver lease rates measure the cost of borrowing physical metal. If lease rates spike, it means holders of physical silver are demanding higher compensation to lend it out because they recognize the metal is scarce. That would confirm physical tightness. Fourth, monitor retail dealer premiums in the United States and Europe. If premiums stay elevated or continue widening, that's another signal that physical demand is overwhelming supply at current prices. And fifth, pay attention to the mining stocks. If silver miners hold their recent gains or continue higher despite the COMEX price crash, that tells you the market recognizes that miner profitability is based on physical metal prices, not paper futures. Several major silver miners are up 15 to 25% over the last month despite the flash crash. That is a huge divergence, and it suggests institutional money is positioning for higher silver prices regardless of short-term COMEX manipulation. Let me address the elephant in the room. A lot of people watching this are probably wondering, Johan, if the market is this manipulated, if the bullion banks can just crash the price whenever they want, why should I even bother holding silver? What's the point if they can just rig the game indefinitely? It's a fair question, and it deserves an honest answer. Yes, the paper silver market is manipulated. That's not a conspiracy theory, it's documented fact. JP Morgan paid $920 million in fines to the CFTC and Department of Justice in 2020 for spoofing the gold and silver markets over an 8-year period. That's a legal settlement admitting to manipulation. So we know it happens, we know the banks do it, and we know the regulatory agencies are either unwilling or unable to stop it. But here's the thing, manipulation can suppress price in the short term, but it can't create physical supply that doesn't exist. The bullion banks can dump unlimited paper contracts on COMEX to push the price down, but they can't manufacture the actual metal that industrial users need. And at some point, the divergence between paper price and physical availability becomes so extreme that the paper market loses its credibility entirely. We're seeing the early stages of that right now. Shanghai paying $41 over COMEX is a vote of no confidence in the paper price. Indian buyers paying 15 to 20 over spot is a vote of no confidence. Retail premiums doubling in the United States is a vote of no confidence. The physical market is telling you that COMEX prices are fiction. And once enough market participants recognize that, the paper market becomes irrelevant. People stop trading futures and start demanding physical delivery. And when that happens, the fractional reserve structure collapses. History gives us examples of this. In the late 1970s, the Hunt brothers attempted to corner the silver market by taking massive physical delivery of futures contracts. Silver went from around $6 an ounce to over $50 in less than 2 years. The exchanges eventually changed the rules to stop them, but the move demonstrated that physical demand can overwhelm paper supply if enough people demand delivery. In 2008, during the financial crisis, there was a shortage of physical gold and silver, even though paper prices were crashing. Dealers couldn't source metal. Premiums exploded, and buyers who wanted physical had to pay far more than the spot price. In 2011, silver spiked to $49 as physical demand from both investors and industrial users surged. The banks eventually capped it with massive paper selling. But the point is that physical scarcity can drive prices regardless of paper manipulation. And right now, we're seeing the same dynamics. Physical is tight. Industrial demand is at all-time highs. Supply is constrained. And the paper market is desperately trying to convince you that silver is worth $95, while the real world is paying $136. That divergence can't last forever. At some point, something breaks. Now, I need to be balanced here because that's what credibility requires. There are legitimate risks and bearish scenarios that could play out, even if everything I've said about manipulation and physical shortages is true. First, the CME could change the rules. They've done it before. During the nickel crisis on the London Metal Exchange in 2022, the exchange halted trading, canceled trades, and imposed cash settlements to bail out the shorts. COMEX could do the same thing if a delivery squeeze threatens the integrity of the exchange. They'll protect the system and the banks before they let retail longs profit from a squeeze. Second, economic slowdown could reduce industrial demand. If global manufacturing slows, if solar panel production drops, if electric vehicle sales decline, industrial silver consumption could decrease enough to ease the physical tightness. That would allow premiums to compress and give the paper market more credibility. Third, new supply could enter the market. If silver prices stay elevated, it incentivizes increased mining production and recycling. Over time, that additional supply could meet demand and stabilize the market. Fourth, the dollar could strengthen significantly. If we see a major risk-off event in global markets and capital floods into the US dollar as a safe haven, that would put downward pressure on all commodities, including silver, regardless of physical fundamentals. And fifth, let's be honest, these markets have been manipulated for decades. Just because the setup looks bullish doesn't mean it plays out on your timeline. Patience and risk management are essential. Don't over-leverage. Don't bet more than you can afford to lose. And don't assume that the market will do what it should do based on fundamentals. Sometimes it takes years for reality to catch up to price. But here's what makes this time different. Every previous manipulation cycle happened when registered COMEX inventory was adequate. The banks could smash the paper price, and the physical market would eventually follow because there was enough supply to meet demand at the lower price. But now, registered inventory is at multi-year lows and dropping fast. The physical market isn't following the paper price down. Shanghai is holding at 136. Indian buyers are accelerating purchases. US retail premiums are widening. The physical shortage is real, and it's getting worse. And that means the next time the banks try to engineer a flash crash, they might trigger something they can't control. Because if enough contract holders decide to stand for delivery instead of accepting cash settlement, if enough market participants demand physical instead of rolling their positions, the system breaks. There isn't enough registered metal to satisfy all the claims. And when that becomes obvious to the broader market, you get a panic. Longs rush to take delivery. Shorts scramble to cover. Premiums explode. And the exchange either defaults or changes the rules. Either way, the paper market loses credibility and physical becomes the only price that matters. So what should you do? Again, I'm not giving you financial advice. I'm not telling you to buy, sell, or hold anything. That's your decision based on your situation. But I'll tell you what I'm doing, and you can decide if it makes sense for you. I'm watching the Shanghai premium. If it stays above 130 for the next 2 weeks, that confirms the physical shortage is real. I'm monitoring COMEX inventory data every single week. If registered stocks drop below 100 million ounces, that's a critical threshold. I'm tracking dealer premiums. If US retail premiums stay elevated or go higher, that validates the physical demand thesis. I'm studying mining stocks. If miners continue outperforming despite COMEX volatility, that's a strong signal that institutional money is positioning for higher prices. And I'm managing risk. I'm not over-leveraged in futures. I'm holding physical metal that I can touch. And I'm prepared for more volatility because this market is a war zone. The banks will try to shake you out. The media will tell you it's over. And the paper price will do things that make no sense based on fundamentals. But if you understand what's actually happening, if you can see through the manipulation to the underlying reality, you position yourself to benefit when the truth finally breaks through. 3 key takeaways from this entire situation. 1, the flash crash from 120 to 95 was not a natural market move. The timing, the volume characteristics, the low liquidity execution, and the fact that it happened right after Trump announced a Fed pick hostile to precious metals all point to coordinated manipulation designed to shake out leveraged longs and suppress the price. 2, the $41 Shanghai premium and the refusal of physical buyers in China, India, and even the United States to follow the paper price lower proves that the physical silver market is operating in a completely different reality than the COMEX futures market. Physical metal is scarce, demand is real, and industrial buyers are willing to pay significant premiums to secure supply. And 3, the ongoing collapse of COMEX registered inventory combined with elevated open interest creates the structural conditions for a potential short squeeze or exchange default if enough contract holders demand physical delivery. The bullion banks are betting they can manipulate the paper price long enough for demand to weaken or new supply to emerge. The physical buyers are betting that the shortage is real and persistent. One of these groups is going to be proven right, and the other is going to face catastrophic losses. Based on the data I'm seeing, I know which side I'd rather be on. So where does this leave you right now? If you're holding physical silver, congratulations. You own real metal that the rest of the world is fighting to acquire at prices far above what COMEX claims it's worth. Do not let a paper price flash crash shake you out of a position in a physical asset that's becoming scarce. If you're trading paper contracts, understand the game you're playing. You can make money in the short term, but you're also exposed to manipulation, rule changes, and the very real possibility of cash settlement at prices that don't reflect physical reality. Manage your risk accordingly. If you're in mining stocks, watch the fundamentals of the companies you own. The best miners with low production costs and strong balance sheets will benefit enormously if physical silver prices stay elevated regardless of paper prices. And if you're sitting in cash trying to decide whether to enter this market, ask yourself this. Do you trust COMEX telling you silver is worth 95? Or do you trust Shanghai paying 136? Do you trust JP Morgan's sell orders at 3 a.m.? Or do you trust Chinese solar manufacturers buying physical at a $41 premium? The answer to that question should tell you everything you need to know. I started this channel, Johan Videos, to give you analysis that you won't find anywhere else. The mainstream media won't tell you about the Shanghai premium. They won't show you the COMEX inventory data. They won't question why commodity crashed 20% in 36 hours with no fundamental justification. They'll just report the price and move on. But this channel digs deeper. This channel asks the questions that matter. And this channel gives you the information you need to make informed decisions in a market that's designed to separate you from your money. If you found value in this breakdown, subscribe. If you disagree with my analysis, leave a comment and tell me why. And if you know someone who needs to see this, share it. The truth matters more than the algorithm. Stay sharp, stay informed, and most importantly, don't let them shake you out of a winning position just because the paper price does something insane for 36 hours. The physical market is telling you the real story. Are you listening? Johan out.